Welcome to our market update for September 2024. So let's just quickly go over some of the key themes that we're seeing at the moment. So firstly, lead economic indicators have actually started to roll over, signaling a slowdown ahead, and that has implications for a range of asset classes, including equities. And we'll talk a little bit more about that in the presentation. Secondly, inflation and interest rates are heading lower, but we think that both of inflation and rates are going to settle at a higher base rate than they have in the last decade or so. And that again has important implications for asset allocation, as well as fixed income returns, which we'll talk about. Thirdly, within fixed income, we see private credit as being one of the more attractive areas for investors. We think that the risk-adjusted returns are very good. The absolute level of income is also very, very good. So we'll talk a little bit more about that. Within international equities, we think they offer the long-term growth portion within investor portfolios, and we think that because of that growth, the current prices are actually offering reasonable valuations. Within Australian equities, we're not as keen on that area, mainly because the earnings growth outlook is very anemic, and a lot of that is coming from within the banking sector. So we'll dive into that. And finally, within small caps, we think that's one area that investors should think about allocating to, given the relative valuation to large caps. So we touched upon growth indicators signaling a slowdown. Some of the areas that we're looking at things like new orders relative to inventories, which is off its lows from late 2023, but in the last few months has actually slowed quite a bit. And the reason that is important is because that is quite a strong indicator and highly correlated with corporate earnings growth. So we'd expect to see corporate earnings growth slowing as a result of that happening. And the other thing that we're looking at is economic surprise indicators, which have rolled over very sharply in the last 3 to 6 months. And again, that's highly correlated with share market returns. So given the market returns have been very good over the last 12 months, that just gives us more reason to be cautious going forward. Now, in terms of inflation and interest rates, as we talked about, we do expect a higher baseline going forward. So if we think about the last decade or so, inflation and interest rates have been very low, averaging, in the case of inflation, averaging less than 2% per annum. Now, fast forward through COVID, we all know that there was some massive inflation shocks going through the system there, particularly around supply chains and goods. Post-COVID, that's come off, which is great news. However, the services side of the economy is taking a lot longer for that inflation to come out. And a lot of that is because the labour market is very tight and wages growth is proving to be quite high and sticky. So all in all, we think that basically leads to a situation where even if we do get an economic growth slowdown, our expectation is that inflation is going to settle at a higher rate going forward than in the past. The other really important dynamic that we're looking at is around the consumer, which is about 2/3 of the economy, and specifically the household sector. So if we think about the household sector, they're basically tapped out in terms of the fact that they're dealing with relatively low income growth, although income growth has been better in the last couple of years than in the last decade. But the other thing that households are dealing with is the fact that the excess savings that were accumulated throughout COVID have been completely depleted. And so basically that just says that consumers are unable to really go out and spend freely on discretionary items. Now, the flip side to that is that house prices and share markets are holding up really well. So there's a large cohort of within the economy, so people that own their own home or investors that are feeling pretty good because they're looking at their wealth, they're looking at their balance sheets, and they can see that those have gone up in value over the last few years. So that really reflects the fact that we do have a multi-speed economy. So you've got borrowers that are hurt by higher rates, and that's what the RBA is trying to do with raising interest rates to kind of push down on inflation. But on the other hand, savers that have assets, that have term deposits and the like, are actually helped quite a lot by higher interest rates. And as investors, we're actually benefiting from those higher rates through asset classes like fixed income and private credit, which we'll talk about shortly. All right, so let's get on to some insights within fixed income. So we talked a fair bit about private credit funds with our clients over the last year or so. And I just wanted to take a moment just to talk about two of those funds that we use quite a lot, being Metrics and Latrobe. So the key points I just wanted to make here is the fact that these types of lenders have benefited a lot in the last decade or so because the banks have actually withdrawn a lot of lending within the Australian economy, in fact, the global economy as well. And so that's just meant that there's a very large opportunity for these private lenders like Metrics and Latrobe to fill that void. Now, Metrics is actually the largest non-bank lender in Australia, which I think is important because when we allocate capital to these types of asset classes, we only want to allocate with the biggest, the best that have scale and can take advantage of high quality opportunities in markets. Just in terms of putting some metrics around the returns from these types of funds, Latrobe is paying about 7.25% currently per annum, and Metrics is paying just over 9% per annum. So we think those levels of returns are very, very good for the risk that you're taking. And you can see on the slide the return profile over the last few years from these funds has been very stable. And this has been an environment when interest rates and inflation have actually been very high, and those dynamics have hurt bond returns quite a lot because bond prices are negatively correlated with interest rates. Whereas you can see on the slide here that Metrics and Latrobe, the value of those investments have been steadily growing because of the stability in the capital price of those funds. And just a final note, which almost goes without saying, but I'll say it anyway, but these funds are highly diversified. So Metrics has several hundred loans, and Latrobe has thousands of loans in their book. So you're not really taking any loan-specific risk. You are taking market risk for the most part. So the key risk here is credit risk, that the economy slows and bad and doubtful debts go up. And so that's the key risk that we're monitoring very, very closely. But to date, these bad and doubtful debt levels have been well and truly under control. But obviously, that's going to be the key thing that we're going to be watching going forward. Now let's turn our attention to equities. So firstly, within international equities, we've shared this chart a few times in our updates. Basically, what we're looking at here is the S&P 500, which is the largest 500 companies listed in the US, the price index in blue, and the earnings for those companies in orange. And down the bottom in that chart, you've got the PE ratio, which is a valuation metric. So first observation is that the fact that earnings growth has been very good over the last 12 months, steadily growing around about that 10% level. And share prices for that same market have been growing correspondingly as well. Now, in the last couple of months, you've seen the share market wobble quite a bit. And a lot of that was due to technical factors and positioning factors. The so-called Japanese carry trade unwind in July, which I won't go into detail here, but basically it resulted in forced selling of equity markets when that happened. And you can see that dip in July, and that's what that was driven by. We then had quite a nice recovery bounce in August, and then in the last couple of weeks we've seen markets kind of take a little bit more of a dip and kind of grinding sideways. But I guess the bottom line here is that the rally in the S&P 500 has been fundamentally driven by earnings, which is a high quality thing and high quality reason to justify that rally, which we like. And valuations, whilst on the face of it are not cheap, trading on about 21 times PE, we think that the quality and the growth of these large multinational companies within the S&P 500 justifies positioning in investor portfolios. And I just wanted to take a little bit more of a deep dive just on two names that we like, and just showing you the fact that whilst the S&P 500 might appear slightly expensive, a lot of the companies within that, in our opinion, are not expensive. And so two of these companies, Alphabet, which would be better known as Google for most people, and the second one being Visa, payment processing business. So in the case of both these companies, what you're looking at here on the slide is the PE ratio for both in blue, and then there's some basically valuation bands that sit around that. So whenever the blue line is below the green line, it's considered cheap. And when it's above the red line, it's considered expensive. So at the moment, both of these businesses are trading cheaply, and both of these companies are offering earnings growth of around about 15% per annum. And by the way, both of them just happen to be operating in sectors that are growing, and these companies are operating in oligopolies. In the case of Visa, in the case of Alphabet, Search, they are the dominant #1 player by a country mile. And then they're basically sharing market within cloud and AI with the other mega cap names like Amazon and Microsoft. So I just wanted to highlight a couple of those names in our portfolios that we think represent good value. Now turning attention to Australian equities. The same slide that I just showed for international is basically shown on the slide here on the left. So you can see that the Australian share market in blue has moved higher over the last 12 months in terms of price. However, the earnings for that same market have actually declined or deteriorated over the last 12 months. So that has led to quite a sharp increase in the valuation for Australian shares. And so when we compare international with Australian equities, we still prefer international equities when we're thinking about growth. However, the key reason that we do want to have exposure to Australian equities in general is the dividends that we're receiving from Australian equities and the franking credits that we're getting from those dividends, which are highly attractive. Now, there's a little asterisk next to that, because when we compare dividend yields with bond yields, what we can see is that fixed income is actually as attractive as it has been in around about 10 years compared to the equity market. So I guess the bottom line is, yes, Australian equities are a good source of income and attractive for franking credits. We just wanted to highlight the fact that that bonds, government bonds in this case, are actually paying you a similar level of income to those equities. So just something to keep in mind, and I guess another reason to think about diversifying Australian equity exposures to the fixed income asset class. And just a quick dive on the Aussie banks. So what we've got here on the left-hand side of the slide here is the valuation multiple for the banks, the 4 big banks here in Australia. You can see they're trading on about 18 times as a group, which is the most expensive they've ever been in history. And the slide on the right shows the same valuation multiple in blue, overlaid with the earnings growth, which you can see is basically flattened out over the last couple of years. So I guess that just further reinforces my point about Australian shares not expected to deliver very much in the way of earnings growth over the next couple of years, and valuations being very expensive. So a significant reason for that is the fact that the banks make up a big portion of the ASX. And if we zoom in a little more to CBA, we can see that CBA is trading on about 24 times PE. Again, the most expensive that it's ever been. Expected to deliver about 3% earnings growth over the next 3 years, so not much there. And then in terms of dividend, we're talking about a dividend yield of about 3% per annum, and that compares to bond yields or cash rates of over 4%. So you're getting a lower yield on a risky share than you are on a basically government guaranteed cash term deposit or cash account. So we don't think that makes a huge amount of sense. The only reason that investors should be paying a multiple of 24 times for this bank is if they think earnings growth is going to be 10% or thereabouts, and we just don't think that's likely, given the fact that the Australian banking sector is most likely trading at or near peak earnings, because debt levels are at their cyclical lows, and the Australian economy is expected to slow over the next couple of years as a result of where households are situated in terms of balance sheets, savings rates, and the fact that unemployment is likely to start to tick up over the next 12 months. So all in all, we just can't quite get our head around the valuation for that stock. Contrasting CBA with CSL, which is one of our preferred Australian growth stocks, this is trading on about 30 times PE, which is trading at the lower end of its historical range, which we think is reasonable. And this business is growing its earnings at about 15% per annum over the next 3 years. So this is one growth stock within Australia that we do like currently. So putting it all together, what are our high conviction views? Firstly is that economic growth is slowing, inflation and interest rates are moderating and coming down. It will settle at a higher baseline than in the past. Secondly, fixed income, very attractive source of income and a portfolio diversifier. So we firmly believe that is going to set portfolios up for a good next 12 months. Within equities, we like international equities or structural growth stocks to provide that capital growth for the long term. We like defensive companies within consumer staples and utilities for portfolio ballast to stabilize returns, and yield or income stocks for that source of income within equities. That combination we think is a good one, given the backdrop that we've outlined and are looking at over the next 12 months. We haven't talked too much in today's slide about commodities. However, we think commodities will be an inflation beneficiary if inflation does indeed settle at a higher baseline than in the past. And a lot of these commodities are facing very favorable supply-demand dynamics. Think about copper and the energy transition and the electrification investments that are going on. It's going to require a significant amount of copper. There just haven't been any major copper discoveries in the last decade or so. And finally, small caps, which we've outlined in previous videos, are trading at very attractive relative valuations compared with large cap peers. So look, thank you for your interest. Thanks for listening. If you do have any more questions, head to our website or send us an email, and we look forward to chatting with you soon.